Hello and welcome to my new video. Today's topic we will be talking about structured products, so let's dig right in. Investors constantly face a dilemma. How do you protect your money in uncertain times while still taking part in market growth? Traditional bonds are safe, but the return is very little. Equities can deliver strong gains, but they also come with significant risk. Structured products are designed to sit in the middle of that spectrum. They combine safety with growth potential. In this video, I'll break down exactly how they work, why investors use them, and what trade-offs they should keep in mind. By the end, you'll see how these products fit into modern wealth management. So, to begin, investor concern. Every investor wants the best of both worlds, which is safety and growth. But traditionally, you've had to choose. Like I said, bonds give you stability and capital protection, but the returns can be underwhelming. Equities, on the other hand, can deliver impressive gains, but they also expose you to sharp market swings and the risk of losing your initial capital. Traditional portfolios try to balance each other out, but many investors just want a product that puts these two all together. That's exactly where structured products come in. So, what's a structured product? It's basically a combination of two familiar building blocks. You have a bond and an option. The bond component is there to protect your principal at maturity. The option component links your return to the performance of an underlying asset. That could be an equity index, a commodity, a currency, or even a property right. Put them together and you get a product that's engineered to manage risk, while still giving the investor some growth potential. The idea is simple. Structure the product so it matches the investor's goals and risk tolerance. Let's use an example to break it down even further. So imagine this. You have 100,000 US dollars into a principal protected note with a 3-year maturity. Roughly 90,000 is allocated to a zero coupon bond, which ensures you'll get $100,000 back at the end of those 3 years. The remaining $10,000 is used to buy a call option on the S&P 500. Now, if the index rises 20% over that period, the option might pay out around $8,000. That means at maturity, not only do you get your original $100,000, you also get $8,000 in gains. But if the index falls, the option is essentially worthless. But you still walk away with your $100,000 intact. The point I'm trying to make here is that these aren't quick trades. Structured products are designed to be held to maturity, often for several years, and the payoff depends on how the markets behave over that time horizon. Benefits. Why do investors like them? The first obvious benefit is downside protection. They help safeguard principal during volatile periods. The second benefit is diversification. It gives you exposure to equities, commodities, currencies, or even property, all through a single product. Customized risk return profiles. It can be tailored individually to meet specific goals, whether that's steady income, protection, or a leveraged upside. And in some cases, they also offer tax advantages. They also improve liquidity solutions. For example, if an executive holds a large portion of wealth in a company stock, a structured product can help reduce concentration risk without a forced sale. Regional trends. So in Asia, structured products demand are at its strongest. Investors there value the innovation in yield enhancement it produces, and adoption has grown rapidly, at one point by nearly 60% in 2004. In Europe, structured products are well established and integrated into mainstream portfolios. They're not seen as exotic, just another tool for balancing risk and return. In the United States, the adoption is at its least. Culturally, investors there tend to prefer direct equity ownership or mutual funds. In my last video, I actually discussed about regional client profiles, highlighting how cultural attitudes and local regulations influence investor behavior. Be sure to check out that video if you haven't seen it. It's really good. The trade-offs. So I'm sure you heard there's no such thing as a free lunch. The safety you get from structured products come at a cost. By protecting your principal, you give part of the upside. Returns are capped compared to direct equity exposure. There's also a complexity element. They can be difficult to understand at first, and so it's essential that clear communication is standardized when delivering this product to your clients, for example. Structured products work best for investors who aren't chasing maximum upside, but instead just want to balance some participation in growth with reassurance if things were to not go as planned. Conclusion. To wrap up, structured products are really just a blend of two elements. You have a bond for the safety component and an option for the growth. They exist to solve the classic investor dilemma, wanting protection without completely missing out on opportunity. But the key takeaway is this: safety always comes off with a trade-off. You protect the downside, but you have to give up some upside. These products can make the most sense when investors prioritize capital preservation, diversification, or even liquidity solutions. And finally, clarity builds trust. Whether you're an advisor, an investor, or a communicator, understanding what you own and why you own it and the trade-offs involved is what makes the difference in long-term success. This has been Alan Explains, and I'll see you in the next one. Take care.